Anyone searching for advice on investing is met with a minefield of different opinions from a whole bunch of gurus pulling you in different directions towards their own views of the best way to invest. But they can't all be right, can they? Many, including some of the biggest names in the investing world, have been very lucky that their chosen method managed to beat the market. Of course, now they look like legends.
In this video, we're going to look at the varied advice from Dave Ramsey, Warren Buffett, Robbie Burns, J.L. Collins, Ray Dalio and Cathie Wood, 6 investing legends, each with their own theories on how you should invest. In analysing these 6 approaches, we'll be separating out skill from luck and the tried and tested winning strategies from the outdated investing models.
Hopefully, by the end, you'll have a better idea of what really works and what doesn't, and what you can realistically do to get a performance that's as good as the experts. Let's check it out.
First, we want to give a special shout out to commission-free trading platform Stake, who are sponsoring this video. Stake are the go-to investing app to buy and sell US stocks. That's because they charge 0 FX fees when you trade.
Instead, Stake converts your pounds into dollars when you deposit money, so you only incur FX fees once, rather than every time you trade as you do on other apps. If you like to trade, this can save you an absolute fortune. And Stake are giving away a free US stock worth up to $150 to everyone who signs up via our offer link, linked to in the video description below. Go check them out.
Dave Ramsey, debt-busting radio star. Dave is the loud-mouthed money master from the Dave Ramsey Show, big on YouTube and on radio. He's famous for his 7 baby steps to get out of debt and start building wealth, but it's really the getting out of debt side of things where he excels. But Dave has apparently had great success as an investor too, and tells his followers to do what he did and they'll be wealthy. He scoffs at suggestions that the market can't be beaten.
Dave Ramsey invests in actively managed mutual funds. Dave's advice is simple: pick mutual funds that have outperformed the S&P 500. In other words, pick funds that have beaten the market in the past. In his own words, you just pick mutual funds that have outperformed the S&P. It's not rocket science. Over half haven't, but don't pick one that didn't. He likens this to picking horses, in that to pick a winner you just need to look at the league tables of past performance.
Dave is obviously incredibly successful. Go to him if you want help getting out of debt, but a great investing mind he is not. He's making the mistake that many newbie investors make by staring into the past and putting faith in fund managers who manage to get lucky and beat the market. Why do we call those fund managers lucky? Well, we did a whole video that dug into the performance data of fund managers over time, which we'll link to below, so check that out. A key finding was that of the top performing 25% of actively managed funds in any one year, after 5 years, less than 1% of them were still in the top quarter.
This proves that being a top performer now absolutely does not mean that they will be a top performer in the future. Any mutual fund successfully beating the market average return simply had a good run of luck. According to Dave, his mutual funds have averaged a 13% annual return over the last 40 years, beating the S&P 500 index by 1.2%, which returned on average 11.8%.
To the naysayers, Dave says, "I have millions of dollars in mutual funds. I wonder how that got there." To this we say that he would still have millions of dollars if he just invested in the S&P 500 index, just a few less millions. And that he was exceptionally lucky that the metaphorical horses he picked managed to finish ahead.
Robbie Burns, The Naked Trader. We love the Naked Trader books. They are what first got me interested in picking stocks. Robbie Burns is an active investor, more of a trader really. He buys individual stocks and holds them for a few weeks or months with a mind to selling them at a profit.
He does this using a mixture of rules around stocks fundamentals, investment tools like stop losses and a good deal of skill. Here's a listing of his most recent trades on his website, linked below. Where there's a positive figure in the final column, these stocks were sold for a healthy profit. The blank cells are stocks which he's still holding on to, waiting for them to either grow significantly until they reach his target sell price or fall by a few percent into get rid territory.
That's the plan, and to be fair, it's a plan that's worked for him for the last 20 years or so. Over that time, he's held hundreds of medium-term positions. If you're good at this strategy, you might expect most of your trades to make 20 to 50% and higher returns, and a minority to make maybe 10 to 15% losses.
This is an active strategy and requires time and knowledge, both of which can be acquired if you take up stock picking as a full-time job, like what Robbie did. He's putting several grand into each position, which makes his time researching stocks worthwhile. This might not be a good pounds per hour strategy if you only have a few quid to put into each stock.
If trading your way to wealth appeals to you, check out Robbie's first book, linked below, and take a free trial of Stockopedia at the link below too, where there's a screener tool called the Naked Trader Screen, which serves you up stock suggestions in line with his stock picking rules. If you're enjoying this content, please take a sec to hit the like and subscribe buttons, and you can now also show support for the channel with the new super thanks button below.
Warren Buffett, value investing legend. Now for a look at the sage of stock picking, Warren Buffett. Buffett is famous the world over for having the golden touch when it comes to choosing companies to invest in that outstrip the market over the long term. Buffett isn't trading stocks regularly like Robbie Burns is. For the most part, he's holding them indefinitely. He picks solid companies that are trading at a discount, which he expects to hold forever.
He's been fantastically successful at doing this, and the companies are again quite different to what a smaller scale stock picker might choose. You, like the naked trader, can invest in small cap stocks. Indeed, this is likely to be where the most growth potential lies. Buffett can't do this as he's too rich. If he tried to buy shares in a small cap, he'd have to buy the entire company, which his people would then have to manage.
Instead, he invests in large caps like Coca-Cola and Apple, but because he has the skill to pick the winning companies and hold them for many years, he was able to profit on the success of these giants over decades and amass a serious fortune.
What's funny though is that Buffett wouldn't tell you to do what he does. He knows he's hella skillful, and that normal folks like us couldn't hope to compete with him, and he's probably right.
His advice to the public is always along these lines. Put 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund.
Will you do as Warren says and go down the index fund route, or will you do as he does and buy individual stocks? Tell us in the comments below.
J.L. Collins, FIRE's investor-in-chief. The financial independence retire early or FIRE movement has captured many imaginations including ours and serves as the blueprint around which we build all other aspects of our financial lives. Withdraw 4% a year from a £1 million portfolio and you can live on £40,000 a year forever as you're only spending your returns and maintaining the capital. That's FIRE in a nutshell.
Collins, author of The Simple Path to Wealth, linked below, quickly became known as one of the FIRE movement's main investment gurus and champions the index investing approach to early retirement. That's because anyone can do it, and it's proven to work.
He recommends a 100% allocation to stocks in the wealth acquisition stage of your life, regardless of your age, specifically into an index fund which invests passively into the total US stock market. An alternative which follows the same investing logic of broad diversification would be something like an all-world ETF.
In retirement, or as Collins calls it, the wealth preservation stage, he recommends adding bonds into the portfolio. The proportion should be in line with your tolerance to risk, bonds being less volatile than stocks. And if you expect to keep earning an income in retirement, you might also reduce your bond holdings.
We can't fault J.L. Collins' approach. With just one or two index funds, it's a low-cost, market-tracking approach that requires almost zero effort to manage and is almost guaranteed to get you to a comfortable retirement and keep you there. But is it as sexy as a more hands-on stock-picking approach with the potential to 20x your money? No.
Ray Dalio, cyclical investor. Ray Dalio is a big-time investor, author, thinker, and manager of the world's largest hedge fund, Bridgewater Associates. Ray has become famous for his Principles series of written works, one of which focuses on the long-term economic cycles of nations. Ray would tell you, for instance, that the US is entering the end phases of its long-term economic cycle, cycles lasting around 75 years, while China is still in the earlier phases of theirs. This leads him to recommend stocks with more emerging markets exposure.
Ray will also tell you that cash is trash and in recent years has decided that bonds are too. The case for both of these sentiments being true is the negative interest rates we have seen the world over in recent years on bank accounts and in the bond market. When interest rates are below inflation, they are negative in a real sense.
Ray pioneered the risk parity strategy of investing, which seeks to either reduce a portfolio's risk while maintaining the same level of overall return, or keep the same risk while increasing return. This works by applying a bit of leverage. Investopedia uses the following example to demonstrate risk parity. Say a portfolio with a 100% allocation to equities has a risk of 15%. Assume a portfolio that uses moderate leverage of around 2.1 times, with 35% allocated to equities and 65% to bonds.
This portfolio has the same expected return as the unleveraged portfolio, but with an annualized risk of only 12.7%. This is a 15% reduction in the amount of risk. We're starting to incorporate these ideas into our own portfolios, which we will of course be sharing with you guys over the coming weeks and months.
Cathie Wood, future-facing tech whiz. Cathie Wood is founder and boss of ARK Invest, a trendy investment management firm. She hit the big time during the pandemic on the success of ARK's signature fund, the Innovation ETF, which invests in disruptive innovation. ARK defines disruptive innovation as the introduction of technology that potentially changes the way the world works. In this, Cathie is looking to the future. DNA technologies, next generation energy storage, robotics, quantum computing, and fintech.
The ARK Innovation ETF smashed all in its path as Cathie's investing method returned month after month of incredible market-beating returns. Here's the performance versus the whole world in yellow and the S&P 500 in brown. There's clearly something to be said for investing in the technology of the future.
UK traders and investors will find it hard to buy ARK ETFs because ARK have not provided so-called key information documents, a requirement for being available in the UK. But you can mirror Cathie's method of investing by buying shares in the top holdings of the ARK funds, which are updated every day. We'll link to this listing below.
So who's right? We fundamentally disagree with Dave Ramsey's high-fee league table approach to investing, and it might be that Cathie Wood just found herself in the right decade to start investing in tech stocks. Time will tell.
If you can pick stocks like Warren Buffett and the Naked Trader, then more power to you. They clearly know what they're doing and are making killer returns by using their stock picking prowess. But if you want to follow an index approach of stocks and bonds like JL Collins, perhaps with a bit of leverage thrown in a la Ray Dalio, this should get you to your comfortable retirement with relative ease.
Question of the day: who's your guru of choice and why? Join the conversation in the comments below. Thanks for watching! On this channel we talk a lot about personal finance, investing and all things money, and if you want to see more great content, please click the subscribe button below.
This is moneyunshackled.com. See you next time.